Okay, I'll record it. Okay, I think it's being recorded now. Okay, so once again, this is our new team member training, and we're going over the basics of Forex trading. So this is what the MetaTrader 4 looks like with the IML scanner. All right. Now, what you'll see is you have these currency pairs right here, and what the scanner does is it identifies a harmonic pattern in the market, and it will actually paint the pattern on the chart for you. It'll tell you where to enter the market, where to take profit, where to put your stop loss to prevent losing a certain amount of money. Okay, and it will actually show you the patterns that are available and how old the patterns are. Okay, now all the patterns in blue are the ones you want to place a buy on. Okay, the ones that are in red are the ones that you want to place a sell on. And I'm not saying you want to get in on every single one. Honestly, what you want to use these for is a reference point. You know, some of these patterns are not 100% guaranteed. Sometimes they don't work out, but you want to pay attention to them, and you want to get good at learning which ones are good setups and which ones are not. All right. So again, what we're doing is we're doing foreign exchange. That's what Forex stands for. And so we're basically placing a bet on whether we think that one currency will increase in value against the other, and we take a position. So you can make money either way. Like a lot of people have money invested in stocks and 401k, and when the U.S. economy takes a hit, most of the time those stocks lose, the 401k loses. Well, over here with Forex trading, you can bet against the dollar, and you can actually, like today, I placed a big sell on USD JPY right here, this right here. And as you can see, the US dollar versus the Japanese yen, basically what happened is the US dollar lost value against the Japanese yen today. We can zoom in and see. See, when you see this chart right here, let me see what the chat says. Okay, great. What are lots? Rich girl, hold it. I'm gonna explain what lots are. Thank you for letting me know that you want that explained. I'm gonna get to that in just a quick second. So when you see this chart right here, you see that you have the green lines, and they're called candlesticks. They're called Japanese candlesticks. We just call candles for short. You have the green candles and you have the red candles. The green candles means in that period of time, the market went up. Okay, the red candles mean in that period of time, the market went down. So, well, Josh, what do you mean in that period of time? Well, look, every chart you have, if you look right here, you have a certain chart. So we're charting the movement of the price over the course of, in terms of months, in weeks, in days, 4-hour time periods, 1 hour, 30 minutes, all the way down to 1 hour. 1 minute, excuse me. So on a monthly chart, every candle represents the range that the price covered over the course of a month. All right. So if this one, you see this one right here, this means the market went down during the course of that particular month. All right, and it went from here to here. If you look right here with this green candle, that means the market went from here all the way up to here over the course of a month. Then the next month starts right here. The price went down, then it came back up, it closed right here. Then the next month started right here, went up, closed here, and so on and so forth. That's how these work. And it works the same way with the weekly chart, the daily chart, the 4-hour, and the 1 hour. So today, big time news came out, all right, called non-farm payrolls as a jobs report. I'll get into that in a second. But as you can see, the market dropped big time. It went down, it came up, and it closed. It finished this candle here, started here, went further down. So actually, the U.S. dollar went down against the Japanese yen today because bad news came out for the U.S. dollar. And so we made money when the market went down. You know, a lot of people make money when the market goes up. You can make it either way. When you buy and the market goes down, you lose money. When you sell and the market goes down, you make money. Okay, when you buy and the market goes up, you make money. When you sell and the market goes up, you lose money. Again, let me break down why. Because if I'm buying, what I'm saying is I'm putting my money in US dollars compared to the Japanese yen. So when the dollar gets stronger against the yen, when it gains value against the yen, then I gain equity. It's just like if you buy a house. When you buy a house, do you want the value of your house to go down? No, you want the value of your house to go up because you gain equity. Then when you close out that deal with that transaction, when you exit out of that transaction, when you sell your house, okay, now you gain the equity as cash in your hand, okay, that goes to your account balance in your bank account. All right, it's the same thing here. Let me see what we have here in the chat. How is the amount determined on the take loss and take profit margins? Okay, I'm gonna break down that right now. So again, guys, this game is about buying low and selling high. What you want to get familiar with is a term, vocabulary term for today is called PIP. PIP stands for percentage in a point. Okay, now the PIP, it actually is how we measure how much progress you're making in the markets. It's kind of our measuring stick. You know how some people use, you're measuring length, you might use inches or feet. If you're measuring, currency, you might be dollars and cents. Well, if you want to measure in a trade how much value you're gaining in the market, how much equity you're gaining, we do it with the unit of measurement called pips. All right, it's our unit of measurement. So a pip stands for percentage in a point, but when we look at the price of the currency, all right, and you have several major currencies that's pretty much that's all most people trade. Let me list them. Okay, I'm gonna show you on the chart because you'll see that they're the first ones listed. You have the euro, EUR. You have the dollar, USD. You have the Japanese yen, JPY. The British pound. You have the Swiss franc, that's CHF. You have the Australian dollar, that's AUD. You have the Canadian dollar, CAD. You have the NZD, that's the New Zealand dollar. Okay, and pretty much that's it. Okay. There are other things that people trade, but these are the most widely traded currencies. They move the most often. Okay, that means they're the most volatile liquid you can make the most money with. Now, when you look at, or if you're trading any of these different major currency pairs, except for the Japanese yen, the pip is the fourth digit after the decimal. So if you see the prices like this, 1.12236, let's say, for example, with the euro. The 3 right here is the pip. Okay, that's the fourth digit after the decimal. That's the pip. You need to know that. If I'm trading a Japanese yen pair, okay, any pair that has JPY in it, the pip is the second digit after the decimal. Okay, this right here, it will be the 4 in this case. So, and if you're trading gold, XAU USD, the pip is the first digit after the decimal. So you just need to understand that. Let me move on, and I'm gonna come back to this in a second. So when you want to place a trade, the reason why people are able to make so much money in Forex so fast is because they allow you to leverage. Okay, they allow you to leverage a large amount of currency in the market with a smaller amount of money. Okay, it's almost like it's on credit or something, but they allow you to leverage big, even without having that much money. Okay, so when you place a trade, your trade size is what we call lot size. Okay, it's based on your lot size. So that your lot size is going to partly determine how much risk you're taking. All right, so the reason why you're seeing a lot more people trading these days is because brokers have come out with less stringent requirements for you to have open accounts that can trade. Some brokers, you can start with $100 or less to open your account. But back when the early days when people first started trading Forex online, I mean, you needed like 10,000 or whatever, or more, 100,000 to trade, depending on your broker. So just understand that you have something called a standard lot. The standard lot, it looks like a $1 trade, okay? It looks like this is 1.00. What that allows you to do is to control 100,000 units of currency in the market. What that equals is $10 per pip risk, okay? So every time when you gain 1 pip, you make $10, all right? So let me give you an example. Right here, if the market was at 1.223, yeah, 1.12236. So let's say, this is 1.12230, all right? And the market went up to, let's just say, 1.12240. If you place the buy on a standard lot, okay, that means you gain 1 pip times $10 per pip, you made $10. You're winning $10, okay? Let's say then from that 1.12230, the market went up to 1.12450. Okay, so all you do is you just subtract. If you're trying to figure out how many pips did I gain, you just subtract. I'll put the zeros on the end so you can feel comfortable. And in this example, you gain 22 pips. Okay, well, how did you get that answer? You take the amount that the price that you started from, and you subtract it from the price that you closed out at, all right, or the price that the market is at now. And then you move the decimal point over 4. 1, 2, 3, 4. So if I did the answer would be 0.0022. So I moved the decimal point over 1, 2, 3, 4. Boom, 22 pips. Okay, so that's how you calculate that. All right. Let me go back to your question here to make sure I answered it, because this is kind of going to your answer, rich girl. What are lots? Okay, I think I answered that. A lot is just like the amount of currency you're controlling, but we break it down into terms you can understand. $1 lot, 10-cent lot, 1 cent lot, or 1.00. We call it a standard lot, okay? That equals $10 per pip. A mini lot, it looks like a 10-cent trade, unless you control 10,000 units of currency in the market. That equals $1 per pip. And micro lot, it looks like a 1-cent trade, allows you to control 1,000 units of currency. That equals 10 cents per pip, okay? So if this went up from 1.12230 to 1.12240, and you had a 10-cent trade in, or a mini lot, you gain 1 pip times $1 per pip. Yeah, I'm doing simple math here. 1 times 1, you making $1, okay? And if you on a micro lot, this is 10 cents per pip. You gain 1 pip, you gain 10 cents. Okay, so just understand that that's how the lot size works and how it determines how much you make per pip. Now, let me see. How is the amount determined on the stop loss and the take profit margin? So what you want to do is you want to do what we call good risk management. Okay, so if you have $100 in your, let's say you got $200 in your account, right? Why would you do a standard lot? You know, if that's $10 per pip, if you lose 10 pips, you just lost 50% of your account. Now you could lose 10 pips like it's nothing. The market moves pretty quick with some pairs. It sometimes moves up 10 pips, down 10 pips. You don't want to be gambling. That's not what this is about. You know, this is about taking good trades, good trade setups, and just, you know, taking advantage of the market with the right timing that you enter in the market and capturing pips. And what I want everybody to understand is you want to focus on growing your account by pips and percentage, and not so much the dollar amount. See, if you had that $200 account and you started out and you put a standard lot, you're doing bad risk management, because like I said, if you lose 10 pips, you lost half your account. You lose 20 pips, you blown everything. They'll close you out even before that happens. Okay, so how you know, okay, what lot size would I suggest? Exactly what I was getting ready to get into. You know, let's say you're looking at the scanner, okay, and you see the stop loss right here. Let me look at a different. Let's zoom out. Maybe that's not it. Okay, you see this stop loss right here. All right. First off, the scanner will automatically, if you have the scanner hooked up, it'll automatically tell you, you know, what percentage risk to take and what lot size to use. So, and it's based on your account balance. So if you have $100 in your account, let's say you got $1,000 in your account. I'm not gonna say $100. Let's say you got nobody, unless you really don't have it and you don't have nothing. I mean, then you can start with $100 in your account. But if you have you seriously you want to learn how to trade, at least put a few $100 in your account, $300 to $500, something like that. You know, $1,000. And that's after you've been on demo for a few weeks. All right. So let's say you had $1,000 in your account and you wanted to only risk 1% of your account on a trade. 1% of $1,000 is $10. So what you would do is you would set up you put your stop loss and your lot size to equate to where if you go from where you enter the market to your stop loss is only $10 away. So the most you can lose is $10, 1% of your account. That's how you're supposed to do. So let's say you put your stop loss is 20 pips away. Okay, 20 pips away. You could do one or two things. You can either change your stop loss you can either put your lot size to 0.05, okay? Because 0.05 equates to 50 cents per pip. Now, if you lose 50 cents per pip, you lose 20 pips at 50 cents per pip, you just lost $10. So you can either put your stop loss at 20 pips away and your lot size at 0.05, or some configuration that adds up to that 1%. Okay, you might want to move your stop loss to 40. Okay, and then instead of doing a 5-cent trade, you're doing a 0.2 trade. All right, 0.02. All right, and you might move your stop loss 50 pips away. Whichever way you want to do it based on the analysis and what it says. And I don't want to get too deep into. Well, I'm gonna get into that later, and showing you kind of support and resistance areas and where you might want to put your stop loss. But just as a general rule, you know, try to do good risk management, 1 to 3%. If you want to be risky, do 5, maybe a little bit more than that. But don't over leverage your account. You know, you don't want to take too much risk. You want to live to fight another day. Okay. You know, you don't have to follow these. This is just kind of some general stuff that I've been telling people to use. You know, if you got $1,000, then you can do a 10-cent trade, up to 12 cents. If you got $100 in your account, you don't want to do no more than 1 to 3 cent lot size. $250 account, up to 5 cents, $500, 8 cents, stuff like that. Okay. Now, let me see here. I know it's something else I meant to go over. Does anybody have any questions before I move on about what I shared thus far? Any questions? This is very simple stuff, but I understand this is like a foreign language to a lot of people. It took me a while to even understand it, really. Does anybody have any questions? Does anybody want to unmute? Does anybody want to have anything they want to clear up? Is anybody listening? All right, I'm gonna move on. I'm going to move on. Let's see here. Okay. Signals. Signals, yes. The signals, we actually give those in our Telegram group chat. We have a Telegram channel, and basically it's a trade. Let me see here if I could. How do I? No, I got Telegram on here. I think I have Telegram. Telegram. Maybe not, huh? I don't know where my Telegram went. Maybe it's on my other computer. Anyways, Telegram, get with I think Tamara, and she can add you to our Telegram page, or Lawrence, anybody, whoever referred you, and they definitely add you out to our Telegram channel. Now, with the signal, how the signals work is basically we'll give you a trade. We'll tell you the currency parity to look at. We'll tell you the entry point that you want to come in, or it might be you get in now, or it might be a pending order. I'm gonna show you how to do a pending order too. The whole point is we're telling you where to get in. We're telling you where to put your stop loss, where to put your take profits, and that's pretty much it. You can just get in the trade, because we understand everybody doesn't know how to do analysis to know where to get in or what is a good trade setup. So in the beginning, we allow you to learn as you earn by giving you some signals, so you can just jump in the trade and make money with us. All right. Now, the only thing you have to make sure you do is just sometimes you might want to just check on your trade, because the market wouldn't, nobody is a god out here, so we don't know. We can't predict 100% every single time, but most of the time these signals are accurate. So I know. Okay, cool. Yeah, they come kind of fast, and you just have to if you can catch them, you catch them. If you don't, hey, it's all good. But what you want to look at, how long do they last? It depends. Some are ready to go immediately. Some are pending orders. Some you get in, they may not take off immediately, because what we're looking at is a setup. We're looking at, okay, when does it look like it's a good time to enter? It may not pop off immediately. Sometimes it pops off immediately. Yeah, exactly. Exactly. That's right. So let me show you how to. First, let me break down a couple things. All right. You see the scanner right here. This scanner is a part of what we call technical analysis. Okay, technical analysis. That's like looking at the harmonic patterns. That's like looking at your charts, trying to find support and resistance levels. I'll tell you about that in a second. That's like looking at the different indicators. All of that kind of stuff is seeing what the price did in the past and trying to find some type of analysis form that will help us better predict what it's going to do next. Okay, that's based on what the price did in the past. We also have something called fundamental analysis. That's analyzing market factors that go on, whether it be news or whatever, that affect things right now. Okay. So I'm going to show you a helpful website that you can go to if you want to bookmark that will actually help you with Forex news. All right. It'll give you the setup for the news, so you can know ahead of, you won't be blindsided most of the time. And you'll have a good understanding of what the news is coming up is. First off, this website called forexfactory.com. You want to bookmark that website. Now, how to use the website is it tells you the date that the news came out. Normally you go to the website, it starts with today's date, and it shows you all the different times that the particular news comes out. So you'll watch. If you weren't watching the markets today, man, they really moved. They really started to just move crazy. They moved real crazy yesterday. A crazy thing happened with the British pound yesterday. But today, is usually the first Friday of every month is what we call non-farm payrolls. Okay, non-farm payrolls, and that's the biggest news. That's the biggest news of the month usually, where the market moves the fastest. As you can see, the news was right here, NFP. That's what we call NFP, non-farm payroll. And what that does, guys, that measures the amount of jobs that was created in the market, the change in the number of jobs created or increase in rate in the number of jobs created from month to month. Okay, and that's big. That's a big telltale story of the growth and the strength of the economy. Okay, so how this works is when you see a folder that's in red, that means the news is high impact news. That means a lot of people are going to be trading that, and the market should make significant moves. So a lot of volatility. The orange one is medium level impact. The yellow is low level impact. Okay, so the red ones, that means the market is going to move big. Now, how it works is this: if that let's put it this way, you click here, all right, you click here in this folder to read what the particular news means and how to interpret it. So it says it measures the change in number of employed people in the previous month, excluding the farming industry. Okay, the usual effect: if the actual is greater than the forecast, that's good for the currency. See, if the actual number of jobs that were created, the change in the number of people that were employed during the previous month was more than they predict, then that's good for the currency. All right. If it's less than they predict, it's bad. That's bad for the currency. Okay. So basically, when people have an idea what the news is going to be, if the news is better than expected or worse than expected, that's going to have a direct effect on the currency. Okay. So at 8:30, this news came out, and then the markets went bananas for a short period of time. All right. And I'm not going to tell you how to get in or how to trade that. Right now, you just want to watch it. If you want to play with it and try, do it on demo. Don't do it with your live account because you might lose all your money. All right, just being straight up. So let me see here. I missed a bunch of messages in here. Let's see. Pending orders. Yep. Yep. Get ready to get to that next. So let's just say that's kind of in the strategy. I don't want to get to that, but I'm going to show you guys how to execute a trade and how to execute a pending order. But this is how you really, this is a good website to see the news. And the news, it has a direct, look, you could be looking at a pattern on the scanner and it could be going perfect the way the scanner is supposed to go. News comes out, it could change everything, because technical analysis, you have to throw it out the window for the most part when the news comes out. Some people say it can correlate, and that may be true. Just understand, a hurricane can happen, earthquake can happen, terrorist attack can happen. Somebody pushed the wrong button and somebody does a bad deal in a company and tanks the economy. Banks get hit and banks go under and the economy tanks. That stuff you won't see that necessarily in the technical. That's all in the fundamentals, all right? And then sentiment analysis. You're really trying to figure out what makes the market go up and go down. Well, it's not the only thing that makes the market go up and go down is people placing trades. Okay, whether it be market makers, that's the big boy traders back in behind the scenes, whether it be the big financial institutions, whether it be the millions of traders around the world. Those people, those individuals or the institutions making trades with large positions or with a lot of small positions, that's what makes these candles go up or go down. All right, think about it: supply and demand. If you wanted to get a commercial during the Super Bowl, it's going to be a lot of money. Okay, why is the price so high? It's because there's so many people that want to get that spot. So the demand is high. Basic Econ 101. Supply is low, price is low. Demand is supply is low, the price is high. Demand is high, the price is high. If the demand is low, the price is low. Supply is high, the price is low. Okay, so just understand that when so many people want to buy, that jacks the price up. Like the price of the Super Bowl is not going to be the same price during the Lions game. No, I'm just joking, guys. I'm just joking. No offense out there to y'all out there in Detroit. You know, I don't mean to pile on the Lions. You know. Yeah, I'm a Vikings fan, so you know we'll see y'all soon. Anyway, so yeah, so when you see people selling, that's putting pressure on the market to go down. All right. So this whole game is just a big tug of war game. If you think about tug of war, okay, you don't usually see one side pulling the rope, okay, all just dragging the other side completely in from the beginning. Normally, it's somebody's taking the lead, then the other person they pull back, okay. Another person they gain more rope, then the other person pulls some back. Then they gain more rope, and pull some back. Then the other side, the stronger one, once the weaker side gets fatigued, then you see the big move. Then you can take a lot of rope. You start dragging them. Then they pull back some, the last ditch effort, and then finally they get dragged across, and you pull the rope away, right? So that's kind of how this trading thing works. You notice the market when the overall trend of the market is gonna win. Okay. However, there are gonna be retracements. There's gonna be pullback. Okay, that's what we call it, pullback. So right here, you see the overall trend of the market here was up. The overall trend of the market was up. The market went up, but it still came down some. Went up, came down some. Played around, went up, came down some. And even with this long drawdown, the market still wanted to go up, so it went back up. All right. So that's how the forex markets work. All right. It's gonna mess with you when you're in trades, because when we're right here and you see when we say buy, you get up here. Oh Lord, you see the market go back down here. You want to close out? Nah, this your target might be somewhere up here to this last high point. Okay, you want to come here. No, then when you saw this, you're like, Lord have mercy, it went all the way back down here. So what? It still ended up here. Okay. Now if you want, you can always close out and come back in, and make the profit. But let me see here. Exactly. Exactly. So pending orders. Well, first let me show you how to do a regular order. All you do is you click on new order, and you make sure that you have. Let me show you how to do it based on what the scanner says. Okay. Let's say this one right here, AUDCAD. Based on the size of this demo account, the lot size, it said the 1% risk of this, based on where the stop loss is, would be 0.19. All right, so do 0.19, new order. Make sure the volume is the same thing as the lot size, 0.19. Put my stop loss where the scanner says, right here, 1.0109. 1.01098. And then I put the take profit right here. I'm going to do it where the scanner says, let's just going to put it take profit 3, 1.00090. 0.00090. All right. Then you just hit sell. Why do I hit sell? Okay. If you're looking at the scanner again, every one of these pairs that are in blue, they're buys. The ones in reds, that means sell. Okay. So another thing to help you, when you see the take profit below the entry point, you know you need to sell, because remember, you want the market to go down for you to make money, for you to make profits. Okay. If you see the take profit above your entry point, you want to buy, because you want the market to go up so you can hit your take profits. Okay. So in this case, you would be selling. So you sell. We would hit sell. You can't do it now because the market's closed. We sell. All right. Cool. How to do a pending order. Now let's just say that the market was like here, and you wanted to get back to here. All right. Or let's just say, you know what? I want to buy when it's a little bit past the entry. I want to buy it here. I want to sell it here. I want to sell it here. Just in case if it gets to the stop loss, I want to at least have a closer entry. Okay, well, whatever. So let's say you wanted to come in at 1.00964. First off, you want to go to pending order. All right, you want to go to pending order, and what you want to do is you have to understand it's 4 different type of pending orders you can do. You can see them right here. You have buy limit, sell limit, buy stop, sell stop. Okay, a limit is for a reversal. Okay, a stop is for a continuation. What do I mean by that? All right, what I want to do in this case is place a sell limit, and like you said, like I was saying before, the price, it might be like 1.00964, something like that. 1.00964. Why would I do a sell limit? Okay, because what the sell limit means is I want the market to go up, and I want it to come back down and go through my take profits. So I will put my sell limit at a higher place than the market is, because I want it to go up and reverse and come back down. I want it to reverse. Okay, and the buy limit you would do, let's say in this example, let's just say that's not a good example. All right, just for the sake of the example, let's just say that the market was here. All right, you could place a buy limit somewhere in this zone. It doesn't matter. I mean, I'm just giving you for an example. And the buy limit, let's say what will happen was it will go down and it will come back up. When it starts to come back up, it will trigger your trade to actually go up and take profits. All right. So the limits for reversals, you have to place it below where the price below where the market was on the buy, the price above where the market is on the sell, because you want it to reverse. You want it to reverse the buy limit. You want it to go down, trigger, come back up, trigger trade, and go up to take profits. On the sell limit, you want the market to go up, come back down, trigger your sell limit, and go to take profits. Now, what is the difference between a stop? Okay, now let's say on this one, you want to do a buy stop. All right, you could put a buy stop here or here, either one. Let's just say you want the market to go up, trigger your trade, and continue to go up. That is how the stops work. On a sell stop, let's say the market was here. The sell stop, you might want to put like a sell stop here, and the market goes down, and it triggers a trade, and it continues to go down. All right. All right. That's the difference between the stop and the limit. So if you see sell limit, just we make it. The signals are easy because you don't have to even look at the chart. But for those who want to understand what's going on, you would be looking at the chart. But just understand that I just showed you how to place a sell limit or a sell stop, a buy limit or buy stop. Okay. Let's see. I think we have a question here. Okay. So I covered a lot with this webinar. I covered what the charts mean. I covered a little bit how to use the scanner. I covered what the currency pairs mean. What does it mean when the prices are going up and down? Oh, one thing I missed. When you click new order, you see 2 prices. One is to sell, one is to buy. The difference between those 2 prices is what we call the spread. Okay. Now the spread is the profit that your broker makes. All right. They do that for various reasons. Number one, they want to make money. They want to make profits. Okay, always number one. It's always about the money. Care what nobody say. Now, number 2, think about it. If you could just come in and just just easily just come in and make trades without there being any type of fee or hindrance with the spread, you would just put $1 million and gain 1 pip and make $10 million on the standard lot. I mean, it's it's just they needed to put something in place to make sure if you place the trade, you know, they can make some off it, and you know, you will actually have to be right on your trade, not just get one pip and make a gazillion dollars. All right. So that's what the spread is about. Some spreads are larger than others. So you see your most commonly traded pair, USD, JPY, Euro, USD, GBP, JPY. A lot of times those have smaller spreads. When the market conditions are very volatile, you notice the spreads increase. The spreads increase because they know the markets are moving bigger moves and moving fast, so they put higher spreads. So you just can't come in and just clean up easy. All right. So I covered the spread. I covered the bid ask price. Let me just cover one or two more things, and I'm gonna close out. All right. I covered lot size. I covered pips. I covered percentage risk trades. I covered the types of analysis. I covered pending orders. Let me just show you just some basic Forex strategy, support and resistance. Let me give you a hint. One of the things that you really want to get good at really quickly is mastering these candlestick formations. Okay, so these when you see these aren't just, this isn't just always random. Okay, when you see a certain candlestick formation, when you see a certain type of candlesticks, right? Oops, what am I doing? Certain type of candlesticks. When you see something like this, you know, this is a different, there are different candlesticks formations. What I want you to understand is they signify something. Like, for example, a reversal. What you always are looking for is some type of indication where the market is going to reverse. Because when you know when the market is going to reverse, that means you can take advantage of a new you can be at the top of a new trend. In any business, you always want to be on the forefront of a new trend. Okay, so get familiar with these candlestick formations. In the self-paid Facebook group, underneath files, there's a candlestick education course, a book, some free books and stuff that you can download and read, and there's some PDFs you can look at to help you understand candlesticks. Okay. Now, in addition to that, you want to also know about support and resistance lines. So the market, if you go and just look at it, even if you look at the scanner, if you look at where the last high from when the market was going the other way, look at the last high and look at your take profit 3. All right. So let's say, for example, your take profit 3 is at the last high last time that the market went up on a buy. So basically, we're saying it at least has to get back up here to touch again. And on your sell, on your, that's on the sell, and on the buy, same thing. It has to at least get to the bottom again, you know. So the buy. So that is when you see the market touching and hanging out in certain areas, that can be what we call supply and demand zones, or support and resistance areas. Let me see here. Oh man. So this is the daily chart, EUR JPY. You notice that for over the last several months, the market has played around in a certain range. Okay, it has let's see here, insert shapes. It's kind of been playing around between here and here. See, this is kind of a support and resistance area here. So you see, support, if you want to think of it in terms you may be able to remember, support is like your floor, resistance is like your ceiling. All right. Support is like your floor, resistance is like your ceiling. So support is at the bottom. Think of you if you were living in a cardboard box apartment, and one day it started raining. All right, the rain came down. If one of your neighbors jumped up, your floor might be wet. Okay, so one of your neighbors jumped up. He could hit his head on the ceiling, yes, or he could tear his head. He can tear a hole in the ceiling with his head. He can, if he jumped up and he tore a hole in the ceiling, he can grab himself, pull himself up. Now he's on your floor in your house, okay, in your apartment. That's kind of like what happens with support and resistance. Support, the price shoots up off support, and sometimes it goes through the resistance line. If it comes back down and it retests the resistance line, and sometimes it continues up. Other times it bounces back down, like this right here. It goes up, tests, come back, retest, and then it went back down. Or it could go back up. Okay? So when you see this right here, this is kind of like the ceiling. This is kind of like the floor. You know, this is just a rough illustration because it's not perfect. But just understand, when you see the market get in this area, that means it could go back the other way. When you see the market get around this low area, that means it could go the other way. And generally, you'll see the market moving in M's and W's. Okay, M's and W's. And well, let me first break this down, and I'm gonna close out telling you about M's and W's. Now, when you see support and resistance lines, you can always find them on pretty much every chart. You know, let me look at a different pair because this is too zoomed in. No, not the GBPs. We're leaving them alone. So like this here. So you can see a general area right here. You see right here. Oops. I can't zoom out any further. Okay, but you can see a general area here. Where the market like to hang out. Okay, where it touched and it went back up. Then you can see another general area. Insert shapes. Hope nobody's drooling. I know it's Friday night, been a long work week. Hey, I'm really really tired these days. But you know, I'm doing this webinar, so I hope y'all not drooling on the webinar and excited about learning this information. So, and I'm wrapping it up. But you can see this is kind of like a common area. So you know when you see the market get up here, you don't need to be buying anymore. Let me tell you something. Never trade when you're out of fear of loss. Never trade out of I say no FOMO, fear of missing out. No FOMO, no FOMO, no fear of missing out. Don't trade because you fear of missing out because you see like right here. Oh Lord, it's taking off. It's shooting up. Let me get in on the buy. Got them. They just got your money because guess what? Whoop! You didn't know it was on a major resistance area. Well, as soon as I got in, it went to it stopped going. It's been shooting up all day. As soon as I got in, it turned around. Yeah, did you mark up your charts? Did you see it was a resistance area? No, I didn't know about it. Oh, yeah, because it got you. You shouldn't have bought right there. You should have been looking. You should have had your charts marked up so you know, hey, this is a resistance area. I'm gonna look at selling. You know, and man, you could have sold it, and well, dang, Josh, I sold it at the top. I sold it high. It looked like it was high, and then, you know, I stayed in. Well, did you take profit when it got to your support line? No, I held it, and it went back up. Oh, yeah, because you need to sell. You need to close out your trade. You sell when it gets down to your resistance area. You can close it out. You can close out, especially if you see it start to go back up. You close it out. I mean, when you get to your support area down here, close it out. All right. Take profit. Then you can wait for looking at it, making a buy. You know, for a buy. But if you notice, even the scanner patterns are W's and M's. So here's how you trade W's and M's. Okay. You You buy on the bottom of the second elbow of the W. You sell at the top of the second elbow to M. Let's zoom in here. Let's see what we can see. You're gonna always see many M's. You see this, of course you see this is a W here, but don't you see this M went up, touched the resistance area, came back down. Didn't go all the way back down. It has to make an M. So when it back up, touch the resistance area. Now it's looking like it's ready to make a big move down. All right. So that's what's going on. Again, the market moves the W's and M's. So, and to understand this too, with support and resistance, when the market breaks support or resistance, like I showed you how I might test and retest. When it breaks, you look for the next support or resistance area. So if I can zoom out to the daily chart, let's just say this continues to go all the way down. I know when it breaks here, the next major area is all the way here. It's somewhere here, you know. So you can know, you can at least probably ride it down to close to this line, this part right here, maybe even a little bit lower. If it continues to go, if it breaks this, it might come back up and retest and go back down. It probably will go down this far. And then you're trying to figure, well, where is the next support area? Well, all you do, you just kind of look here, and it's probably somewhere here, you know, somewhere here. So you maybe can ride all the way down here. So that's kind of how you do it. And it's the same thing with resistance. If it goes back up and breaks, you know, maybe the next resistance area is here. Maybe it's here. And then above that is here. It's the area here. So you want to mark up your charts. That way you know if you're in a trade, you know when is a good time to take profit and when is a good time to even enter. Okay. So that's pretty much I covered a lot this evening. And if anybody has any questions before I wrap up, I'll answer the questions and then we'll call it evening. I'll see you on Monday. So can you repeat buy on the second elbow? Yes. Again, you will always want to buy low and you want to sell high. So when you're selling, you want to sell at the top of the second elbow of the M. Okay. And you want to buy at the top or at the bottom of the second elbow of the W. Just, you know, you just want to make sure that you have enough what we call confirmation to feel comfortable doing that. You don't want to get in because it looks like an M and it's no kind of, it didn't already start going down or it's not at a resistance level. So and none of that kind of stuff. You wanna give a little bit of confirmation, so you don't necessarily have to get in at the top of the M, because how would you know that it's going down? So just you can kind of give yourself a little bit to where you can see the M start to formulate. Then you can jump in on the sell. And the same thing, the opposite for the W. Okay.
When you come.
All right.
Hey, Josh, you're doing a great job tonight, man. Appreciate it.
Okay. Hey, appreciate it, big brother. Appreciate it, sir. Man, y'all just been, a lot of y'all been killing it with this trading game, and you know, we're just kind of getting started. We're really still novices with this. We're all learning. You know, I'm not trying to make myself the Forex guru. I'm far from it. I'm trying to learn this game and you know, win big, just like all the rest of us. You know, we just wanted to create something where we can show all the new people the basics, and then you can get with IML and learn on top of that from there. Stay plugged in our community, absorb yourself in books. If you're whatever Facebook group you're a part of, make sure a Telegram group or whatever group you're part of, make sure that you can get the content, extra content, whether it be books or whatever that you can download and read and educate yourself. So you want to educate yourself on the weekends. The weekends are for market up charts, for looking at trades and educating yourself so you can grow, because the markets are closed. There's nothing else you really can do. You can't be trading, you know. So let me give you one last website that you can use to do a little bit of homework to get familiar on some of the terms and things like that. babypips.com/school. Understand it's going to be a lot of advertisements and stuff on there. Just disregard that. You know, just use the site for what it's for, and that's just to get the free information. All right, don't worry about the advertisements. So I'm gonna just give you this site here. Make sure you watch the videos though in your IML back office, because that's what it's there for. This is just an extra website for those who like to read things instead of necessarily watching the video. On top of that, actually. So with that being said, are there any other questions before we close out? Going once, going twice. All right, everybody have a wonderful weekend. And like I said, connect in the Telegrams. If you have any questions, go ahead and ask them in there. Otherwise, we'll see y'all at the top. See y'all Monday. Bye-bye.